If you own your home, there is a tax sitting quietly in the background that almost every homeowner gets wrong. And getting it wrong costs real money. Some people overpay it without ever realizing they had a choice. Others are so frightened of it that they will not sell a house that has become too big, too expensive, and too much to keep up. So they stay trapped for years to avoid a bill that for most of them does not even exist. And almost nobody has ever sat them down and explained the one break written right into federal law that wiped this tax out for the vast majority of homeowners. That is the quiet unfairness of it. The break is enormous. It is sitting there waiting for you, and nobody whose job touches your money has any reason to explain it before you make an expensive mistake. I'm going to walk you through exactly what the IRS really takes when a home is sold. The break that erases it for most people. The special window that protects widows. The rule that resets the tax to almost nothing when a home is inherited. And the well-meaning move that hands your children a giant tax bill instead of saving them one. Stay to the end, because the last point quietly does the most damage. And good people make it every single day, thinking they are being smart. Number 1 is the break that wipes out the tax, and once you understand it, you may feel the fear lift right off your shoulders. When you sell the home you have lived in, federal law lets you exclude a huge amount of the profit from tax entirely. A single person can exclude $250,000 of gain, and a married couple filing together can exclude $500,000 of gain, completely tax-free. The only requirement is that you owned the home and lived in it as your main home for at least 2 of the last 5 years. For the ordinary retiree who bought a house decades ago and lived in it ever since, that exclusion covers the entire profit, and the tax bill they were so afraid of comes out to zero. Number 2 is the single most important word in everything I just said, and it is the word gain. The exclusion is not about the price you sell for. It is about your profit, and your profit is only the amount above what you originally paid for the house, plus the money you put into improving it. Most people hear that their house will sell for $400,000, and they panic thinking they owe tax on $400,000. You do not. If you bought it for $100,000 decades ago, your gain is the difference, not the wholesale price. And then the exclusion sits on top of that to wipe most or all of it away. And here is a detail that saves real money. Every major improvement you ever made, a new roof, a kitchen remodel, a room addition, a new furnace, all of it gets added to what you originally paid, which lowers your gain even further. So keep those records, because the more improvements you can show, the smaller the taxable profit becomes. Number 3 is a special protection for widows that the government will never go out of its way to explain. When one spouse dies, the survivor needs to know about a 2-year window. If you sell the home within 2 years of your spouse's death, you can still claim the full $500,000 exclusion, not the smaller $250,000 amount that applies to a single person. That is a difference of $250,000 of protected profit, and it disappears the day that 2-year window closes. A widow sitting in a home that has gained a great deal in value needs to understand this clearly, because waiting too long to sell can turn a tax-free sale into a taxable one for no reason other than not knowing the clock was running. Number 4 is connected to that, and it is one of the most powerful and least understood rules in the entire tax code. It is called the step-up in basis. When you inherit a home, or when you inherit your spouse's share of the home you own together, the value of that home is reset for tax purposes to whatever it was worth on the day that person died. All the gain that built up over all those years simply vanishes. So, a widow who inherits the family home and then sells it often owes little or nothing, because her starting point is no longer what the couple paid in 1975. It is what the home was worth the day her husband passed away. In the states that treat property as community property, the entire home gets that reset, not just half. This one rule is why patience and proper planning around a home can save a family a fortune. Number 5 is the well-meaning mistake I warned you about, and it is the opposite of everything I just described. Out of love, a parent decides to put a child's name on the deed, or to give the house to the children outright, or even to sell it to them for $1 while still alive, thinking this avoids hassle and passes the home on cleanly. It does the reverse. When you give your home to your children during your lifetime, they do not get that step up in basis. They inherit your original low starting point instead. So, when they eventually sell, they get taxed on decades of gain that would have completely disappeared if they had simply received the house after you passed away. You can turn a tax-free inheritance into a huge taxable event with one trip to the courthouse. And on top of that, the moment you put a child on the deed, you give up control. If that child gets divorced, the house can be pulled into the divorce. If that child is sued or owes money, a creditor can come after the home you still live in. The instinct to be generous and proactive ends up costing the very people you are trying to protect. Number 6 is permission, and I want you to really hear this one. Do not let a tax you probably do not owe keep you trapped in a house that no longer serves you. So many seniors stay in a home that is too big, too dangerous, and too expensive, purely out of fear of a bill that the exclusion and the step-up would erase. If the house has become a burden, run the real numbers with someone who knows them, and you will very likely find that selling and moving somewhere smaller, safer, and cheaper to run costs you little or nothing in tax, and gives you back money and peace every single month. The home is supposed to serve your life. Your life is not supposed to be held hostage by the home. Number 7 is for the small number of you whose gain is so large that it does go beyond the exclusion. And even here, there is a way to soften it. The tax on a home sale profit above the exclusion is a long-term capital gains tax, and that tax has a 0% rate in years when your other income is low. So, if you are in one of those lower income years, especially in the early part of retirement, before forced withdrawals begin, timing your sale into that year can put part of the taxable gain in the 0% bracket and shrink the bill even further. The sale you cannot avoid being taxed on can still be timed to be taxed as gently as possible. Let me bring it all together, because the thread here is the same one that runs through everything. The home sale exclusion is enormous, and it is sitting right there waiting for you. The tax is only on the gain, not the price. Widows get a 2-year window worth $250,000. Inheriting at death resets the gain to nothing. Gifting during life throws that reset away and hands your children the bill. And the fear of a tax, that for most seniors does not exist, is quietly trapping people in homes that are wearing them down. Not one of these rules is hidden. They are all right there in the law. But nobody whose job touches your money has a reason to sit you down and explain them before you make an expensive mistake. Nobody is going to call you and tell you the exclusion exists, or that the widow's window is closing, or that putting your daughter on the deed will cost her more than it saves. The only person who can use these rules in your favor is you, and the time to learn them is before you sell or sign anything, not after. Find a fee-only fiduciary advisor or a tax professional who can look at your actual numbers and bring them every one of these points. I will put the things to ask about and the details in the description below. So do one thing for me. Send this to one person you care about who owns their home and is either thinking about selling, thinking about putting a child on the deed, or staying stuck in a house that is too much for them out of fear of the tax. A parent, a brother, a sister, a neighbor, the widow down the street rattling around in a house that is wearing her out. The chances are very good that she is afraid of a tax she does not even owe, and one share from you could give her back her freedom and save her family a fortune. That is what we are here for. I will see you in the next one.